Hello and welcome to episode 453 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leaks. Damien, how are you doing?
I'm good. People watching this on YouTube will notice that I tend to be smiling quite a bit at the beginning of the podcast because we never always start them so smoothly, do we, Andy? Sometimes it takes one or two goes to get going, and I'm laughing.
It's very kind you're saying, do we, because it's very much down to me to bring the intro. So.
Andy just introduced himself as me, so anyway, I'm good, Andy, and today has been another base rate decision day. So we often record the podcast on a Thursday, and so because the base rate is announced by the Bank of England on a Thursday, that can be good or bad, because if there is a change, that means there's a lot of content and insight that we have to provide. This week or this month, the base rate actually didn't change. It's still 5.25%. So if you listen to this, you know that nothing has changed from all of the insights that we've given on previous shows regarding the base rate. We'll put a link actually in the notes of this podcast, just to the latest news piece, which has some of those insights in there as a summary. But the good news this week was that inflation was slightly under expectations. So there's a hint that we could, or the Bank of England's at least hoping that we could head towards 2% inflation target sooner rather than later. So that's all good news, I suppose, especially if you're somebody with a mortgage, not so much if you are a saver. Before we move on to the podcast and say what's on it this week, Andy, I just want to say to people, please do review the podcast. We want to collate a number of reviews, then we'll read them out and you may win a Money to the Masses mug. Do please review the podcast. Don't be one of the many people who might listen to it and think, oh, I will get round to it at some point. Please do review the podcast and email in as well if you so wish to tell us how much you're enjoying the show. So I'll go straight on and tell the listeners what's on this week's show. We've got a piece regarding something that happened to Justin, in fact, my twin. So every now and then something will happen to somebody in the Money to the Masses offices which will give rise to one of those did you know that kind of conversations, and it's in relation to a claim on car insurance, and in particular something that I think everybody should know about and watch out for in relation to courtesy cars. So this is something that could end up costing you thousands of pounds, so that's something that's worth listening to. Later in the show we will be doing the end of tax year checklist, as I promised last week. That will be a real whistle-stop tour of what to do before the end of the tax year. So you're going to have to listen to that. And Andy, you're doing a third piece on...
I'm going to be doing a piece about complaints that have been lodged with the Financial Ombudsman Service. There's been a rise in certain complaints, and we'll go through what those complaints are, how they come about. And there was a specific rise in irresponsible lending complaints. So we're going to focus on that and why that is later on in the show. So shall we go with the first piece then? So we're going to be talking about something that happened to Justin.
Yeah, so this is one of those stories, as I mentioned in the intro, that you find out something that you didn't quite know or appreciate. And we had the conversation. Nobody really understood the nuances of what happens when you sometimes make a claim on your insurance and you are given, I do the annoying inverted comma thing that doesn't work on audio, the courtesy car. So when you think you're getting a courtesy car. So just to give you the very short story, Justin was parked in a car park in his car, stationary, and then somebody decided to reverse into the parking space behind him at speed with a very large vehicle with a tow bar and effectively went straight through the back of his car. Now, the damage was obviously significant, but it didn't stop the car being able to be driven. Long story short, it has to go through, obviously, insurance, making a claim against the other person because they are fully at fault. Now, where this story got interesting is that Justin was waiting to have the courtesy car. So he rang up the insurer. They had said, right, they would contact them about arranging a courtesy car, and they would be in touch with the other person's insurance company, and they would take it from there. So what you'd pretty much expect. So Justin, on his insurance, had obviously opted to have a courtesy car. Now, where this got a little bit odd was that the person came to deliver the car to him and take his car away to be looked at and potentially be repaired. But of course, there's a bit of a journey on this because you've got to wait for the other insurer to obviously authorise what's going on. The car was delivered, the person turned up, with the iPad, as they often do, and then ask you to sign the agreement that you're meant to read through. That wasn't working, so Justin was subsequently sent the agreement hours later to go through. And this is where he started to look at this agreement, and then the alarm bell started to ring. Because, in fact, what it was is it was actually something called a credit hire agreement. And it was only via digging that often what happens is you may have an insurance policy where you get a courtesy car. If your car's damaged, it needs to go in for repair. So it's obviously for your convenience. What he was unaware of, that through the conversations, somebody had rung him up, which he presumed was from the insurance company, to say that they were going to arrange the replacement car that he would have for the period of time when his car was going to be probably in the garage. And they said it could take up to 5 weeks. Justin had the agreement and then started to look at it before he signed it and would actually take use of the car. And he did find it a little bit odd that he was actually given the option of having a Tesla. So we're not talking about having a cheap car here. He was actually offered a range of cars, which he did think was quite generous. And when looking at the agreement, he started to notice that there was an agreement that was actually a credit hire agreement. Effectively, the agreement was him hiring a car from this company, and this company was going to charge, and it lays out the charge. And I've got a copy of the agreement here, so you're going to hear some paper rustling, which again isn't fab for listening, but I just want to read through some of these charges. So when he was looking at this, he could see the charges that were going to be applied on a daily basis. So when looking at the agreement, in the charges section, there was a £200 charge for delivery and collection. There was a charge for COVID-19 cleaning. There was a charge for the car being an automatic of £8.50 a day. There was a charge for it being an estate car of £8.50 a day. There was a daily charge of £250 for having the car. There was an £8.50 charge for this, what he thought was a courtesy car, having a sat-nav. So when you total all of this up, already you're looking at a charge that's on a daily basis heading towards £300. There was also going to be a charge applied under this agreement for his car to be stored at the garage where the repairs were going to be made. He'd already been told that this could take up to 5 weeks. So given that in his circumstances, the car was drivable because the damage was actually under the back of the car, but it was still legal to drive it, and there was nothing potentially wrong to be able to drive it around. It was something that was much more to do with the bodywork of the car. When he looked at the agreement, it started to state that everything was between the car hire, effectively company, and him. So he was liable for these charges. And it was very clear that it was lots of bolding about you and his liability and the agreement between them. When he worked it out, the car hire for that he would be signing up to would end up over a series of weeks, when you're looking at sort of £300 plus. That would be heading towards about, over £2,000 a week. If he's going to do that for 5 or 6 weeks, you're looking at £10,000 to £12,000. Now, when he spoke to the company, it was always made very clear, that you won't be paying this. But it's not strictly true, because this is why we're bringing this up on the podcast. Because what tends to happen is the idea is that these types of agreement allow the company who is providing this service, and they are called a claims management company, and they help with the replacement and repair of the car. And unbeknownst to him, what actually happened is that he'd been passed on to this third party by his own insurer. And so when he looked at this agreement, he rang them up, and obviously they were very keen he signed it. He said, I'm not signing anything, and I don't actually want that car. My car was drivable. I'm not paying or liable to have to pay charges for it to be stored somewhere for basically 5 weeks and racking up this £300 a day charge. When put on the spot, he asked them, would he technically be liable for this? They said, well, no, because you're not at fault, then it will be recovered from the other person's insurer. The insurer will fit the bill. So you won't pay anything. So this is just what happens when you go and have a car that's going to replace the one that you're obviously having repaired. But when you look at the legalities of it, technically, if for some reason he was to be found at fault, then he is in theory liable to these charges. Now, when he spoke to an insurance company, they said, look, this has never happened, and try and tell you it's a 1 in a million chance. But the legalities are that he technically is signing a credit hire agreement that states that he is liable. Now, I'm going to just read you a bit off of the final stages. There's so many words in the documentation I've got here, but one of them here, it said at the declaration, I understand that by signing these documents that I am entering into a credit agreement. He never wanted a credit agreement. He just wanted his courtesy car. And I understand that the charges I incur will form part of my claim, which I'm making as a result of a non-fault road traffic collision. And now they go on to say that obviously the information they give, or he's giving us at the best of his own, of his knowledge. And he's also aware that in order for these charges to be recoverable, that he will need to cooperate with them in a reasonable way. Okay, fair enough. But he's also been made aware that these charges are incurred by me, as in him, I'm reading it off the paper, and are owed until such time that they have been successfully recovered. So this started obviously ringing alarm bells that technically you are entering into agreement with this third-party company, entering into a car hire arrangement, which he only worked out because he looked at the documentation. Most people would get the car and just sign the piece of paper or the iPad and they move on. But they're racking up charges that they potentially could be liable for. Now, the idea that this is something that happens all the time and there's never anybody that falls foul of it is not strictly true, because if you look on the internet hard enough, you can find cases where people have been liable and have been come after to pay for these, where they've been found at fault themselves. It wasn't a no-fault claim in the end. Now, the interesting thing is that he went back to his insurance company and said, I'm not happy with this. I thought I had a courtesy car. And they said, well, you do. But the claims management company, therefore, won't be dealing with your claim. You have to say that you want us to do it. And therefore, you can have the free courtesy car, but we can't guarantee you'll get one, and we can't guarantee the type of car you will get. And that is stated in the T's and C's of his insurance policy. And he was like, well, that's what I would rather do, because he didn't want to sign up to a credit arrangement and potentially be liable for a huge bill somewhere further down the line, despite how much the insurance company or the claims management company would claim is unlikely, how unlikely that is to occur. So obviously he wanted to claim via his insurance company, as he thought he was going to. That would mean he'd pay his excess on his policy and he'd eventually get a courtesy car when his car went into the garage, so he had his own car back. He could drive that because the damage isn't enough to make it not roadworthy or illegal. And one of the things that smooths over the claims management route is that claims management company, you won't have to pay your excess up front. So that is something that most people will probably be just happy. Think of it in the round, a lot of people would just go, yep, it wasn't their fault. Someone's turned up with a nice car they're driving around in and they haven't had to pay any money out. But the reality is there is a bill that's racking up. And of course, ignoring whether you are going to be potentially liable in the future, there is, I think, an ethical thing here, because he could have put his car in the garage and the other person's insurance company is going to foot a bill potentially for £10,000, £12,000 for him to be driving the car with all these ridiculous extra charges. And that is putting up people's premiums. Now, I've read some research that suggests that some of these practices, such as the credit hire arrangements, are actually increasing people's premiums by £3 in every 10. So this is one of the reasons why our car insurance premiums are going up, which is, I think, needs to be looked into. And not only are people being misled because they're not sure what they're signing up to, that the rest of us are actually footing the bill. Now, you may sit there and think and argue that it kind of might come out in the wash with different people's insurance. Each insurance company is being treated in the same way. The people in the middle, these claim management companies, are actually making a fair bit of money. Now, one thing I just want to point out is that it can end up that you could be liable for some of these bills. And it's actually ended up in a number of financial ombudsman complaints. And if you look at the numbers, it's not huge. If you're going back to the last year, then there's been 180 complaints to the financial ombudsman. But there is this weird grey area that's occurred, because previously, if you go back to pre-2019, these claims management companies were regulated under the claims management regulator, and complaints about them were dealt with the legal ombudsman. Since April 2019, that's changed, and they are now under the Financial Conduct Authority, so the FCA, and complaints have moved to the Claims Management Ombudsman, which is called the CMO. The problem is, when you look at this agreement that Justin had, it points in there everywhere that this credit agreement is exempt from the Consumer Credit Act. And so that means it's unregulated, which also means that if you want to make a complaint about these things, they fall outside the scope of the FCA's rules, and therefore you can't end up going to the Financial Ombudsman Service about them. The only way you can end up, if you have a complaint and go to the Ombudsman, is if you complain about the insurance company that you had your insurance, or you've got your car insurance with, perhaps because you felt you were misled and ended up down this route, because the complaints that have come to light are where people have ended up footing some or all of the bill because the claims management company couldn't recoup that from the other insurer that was involved in the case. So this is a piece that there's more details. I'm going to put a link in the notes to a very good article I read about the topic. There's very little on the internet discussing this. It gives you a bit more detail about what's going on. But the main thing I want people to realise is that this exists. So yes, if your car has been written off or it's going into the garage, then this route is obviously going to be attractive to you, because one other thing you'd end up doing is having to hire a car, and it could be upfront costs and it won't be affordable for you if you've not got a car. This route, obviously, there is charges, and ultimately it will be the other insurer that should end up paying. So for most people, they don't ever know that they've gone through this route and there isn't a problem. But of course, there are rare occasions where it can come back to bite you. Now, yes, as I mentioned, for most people it never will, but what I want to do is say to people, be aware of the risks of anything that you do and what you're signing up to. This is a classic case of somebody looking at the T's and C's in their own time, not being rushed at the door, and then being told subsequently when they raise concerns that, no, don't worry about it, you will never pay. Well, technically, the documentation says you would do, and you should have a choice. If you're happy with those risks, then that is fine. If you're not, then, as Justin was, he decided to go down a different route and actually use your courtesy car that he's entitled to. He doesn't know what he will get when the car goes into the garage, but the point is he paid for a courtesy car under the policy. This is going through a separate route where you end up getting a car, or you end up hiring a car. It's very different.
I just don't know how this has come about, because it seems to me the numbers there are in black and white, that they're estimating it's adding a roughly £3 to every £10 in insurance claims. Now, it's difficult to corroborate those numbers, but I know for certain that my insurance premium has gone up around about 30 to 40% in the last year, and I was given various reasons by my insurer as to why that is. I would hazard a guess that possibly increased claims in terms of the total cost of claims, because of things like these claims management companies and the charges that they're charging, has got to be some sort of part of that. And it doesn't sit right with me. This feels a little bit murky.
Yeah, and always ask questions. That's the other thing. And just as an aside, the reason that Justin got really noticed it was because he had a calling off period in the agreement, and therefore he's thinking, I've got a 14-day calling off period. Well, what is it I'm signing up to? Because obviously calling off periods are things that you have when you're signing up to some sort of agreement. Normally it's a financial product, in fact, you normally get them. But that started him to think, what am I signing up to? Starting reading the details. So do be aware. It is part of the murky world of car insurance. It seems to be embedded in that world, but it's only when somebody actually looks at it and it comes to light that there is a bit of a liability there.
Okay, let's move on to the next piece of the podcast then. And actually this is about financial complaints as well. So it kind of ties in a little bit with the last piece that we did. Especially so because we're going to be talking about claims management companies again, slightly different though this time. So according to the latest complaints data from the Financial Ombudsman Service, for October to December 2023, consumers lodged a record 5,660 complaints about their credit cards. Now, that is the highest ever level for a 3-month period. Interestingly, and this is what we're going to come on to, 3,086 of those complaints were due to perceived unaffordable or irresponsible lending by financial firms. So this is what we're going to concentrate on this piece. So just to provide some context to those numbers, a year previous, there were 3,216 claims compared to 5,660. of which only 665 were due to irresponsible or unaffordable lending. So the numbers have significantly increased.
So what's been driving that increase?
Well, there's been a massive increase in the number of claims. In fact, 3/4 of those claims were submitted by claims management companies, similar to what we've been talking about in the previous piece. Now, during the PPI period where there was the mis-selling scandal, these companies came to the fore, and essentially they would create a complaint on your behalf on a no-win, no-fee basis. And if you won your case, that's great, you'd win your money, but the problem is you'd win your compensation, but the problem would be you'd have to pay some of that away, up to 40% in some cases.
So you could, theoretically, or you'd hope you might increase your chances of winning, and in fact, I think you're going to tell us there's not a lot of evidence to suggest that's the case, but you definitely, if you do win, you're going to get less than you would have done otherwise.
Yeah, that's right. I mean, the uphold rate for these complaints that have been brought about by the professional representatives, which are the claims management companies, was just 14%. So just 15 in every 100 have been upheld, and that compares to 44%, so almost half, for the consumers who brought their complaint themselves.
Okay, so you are definitely looking at that less likely to be winning going via a claims management company. Of course, there is something, it's that cause and effect that you have to be mindful of statistics, that some of the people who might be going down that route are the people who think they've got less chance anyway, but clearly they are, for want of a better word, the ambulance chasers that are trying to get through as many claims as they can to get their cut of any potential compensation or money that's been awarded.
Yeah, and the Financial Ombudsman Service have released the data, and they've also released some advice for consumers, which, and I'll read it out here because it's quite important for this part of the pod. It says, while professional representatives have an important role to play, we're currently seeing some poorly evidenced complaints. And in these circumstances, uphold rates can be considerably lower than if a customer brings a complaint direct to our service.
So jumping back then, so could you give some examples of irresponsible lending, just so podcast listeners can hear examples and think whether they, or recognise whether they've been somebody that's fallen foul of that practice. But then we can then finish up on the things that people can do rather than using a claims management company if they want to put in a claim.
Yeah, so I'll run through some quick bullet points on how to sort of identify what is irresponsible lending, because lenders have to follow a certain code of conduct. So essentially, it's not responsible for a lender to lend to someone without checking that they can actually afford it in the first place. So the loan might be, for example, bigger than it is needed, or it might be too big to pay back. If that is the case, then they are two examples of where potentially the loan has been given irresponsibly. It is also considered irresponsible if it can cause an individual to, and I'll read out some of the bullet points here, cut back on their essential living costs, fall back and fall behind on certain payments, or if it leads to an account defaulting. So responsible lenders need to be confident that you can repay this debt. So they need to ensure that you can pay it in full and on time without you having to borrow more money, without falling behind on bills, and without causing you financial hardship. So taking that all in, then you can complain to your creditor if you believe that they've lent you money irresponsibly and you are now struggling financially as a result.
So what is the process then of making a complaint?
Yeah, so you should advance your claim yourself, ideally. And of course, remember, before you go to the Financial Ombudsman Service, you need to speak to your creditor or your lender first to make that first complaint. So speak to them, ask for a copy of their complaints procedure, and you'll then be given details of how that complaint will be handled and also the timescales as well. And then subsequently, if you're unhappy with that process, you can then go ahead and speak to the FOS. And we'll put details in the show notes on how people do that. We'll put a link in there. But essentially, it's just filling in a form, and it's relatively simple and straightforward to do. You go through the details on the form and you state your case.
Yeah, and that will go, obviously, as Andy said, directly. You can do that via the Ombudsman Service and therefore progress your next stage of your complaint to them so they can then obviously make a decision. So,
And remember, it's not just about those types of complaints in terms of irresponsible lending. You can go to the Financial Ombudsman Service if you're unhappy with anything to do with your finances. So, of course, if it's anything to do with insurances or credit cards, current accounts, go through the normal complaints procedure with that person and then on to the financial.
Yeah, and that is something that's always worth bearing in mind. You do get a lot of people who think the ombudsman is the person you complain to, but they're the one that make a judgment on how you've been treated and how your complaint's been handled. So that was a good piece, Andy. We'll move on to the final piece of the podcast, which we're going to rattle through, and it's the end of tax year to-do list, which is something we talk about most years. I'm not going to go into each point in detail. We'll put a link in the notes of the show so you can find the article, but then you can navigate around the Money to the Masses website from that article to find details specifically relating to each point. So I'm going to start with pensions. Now, obviously, tax year end is coming. You can obviously pay into your pension. You're going to run out of time, or not use your allowance, I should say, if you don't pay in before the end of the 5th of April 2024. So if you want to use your allowance, your pension contribution allowance, then you should use it before the end of the 5th of April. Don't forget that at the moment the annual allowance is capped at £60,000, and that's the amount at which you can get the full tax relief on, but it also is dependent on your earnings. So it's 100% of your earnings or that cap, whichever is lower. And also, if you don't have any earnings, then you can technically put 3,600 into a pension. That's the gross amount, and you do get tax relief on that as well, which is at the basic rate. So that is something to bear in mind. I say more details in the article. There are people out there who may be in a fortunate position where they want to pay more into their pension this year and want to be able to claim tax relief on it, but they obviously will max out that allowance of £60,000, but they've got earnings that are much more than that. It is possible to carry forward unused pension allowances from the previous year. So any unused annual allowances, you can carry them forward and use them from the previous 3 years. There are certain rules around how you do it and the order in which you do it. I'm not going to go into detail on that, but if you earn particularly a large amount of money and you want to put more than that £60,000 into your pension, then it is possible to do that, and it is still possible to get tax relief. Simply, you have to have earned enough money to pay enough tax for the tax relief to occur. Now, an alternative thing you could do is pay into your spouse's pension. It is possible to pay into a spouse's pension who is not earning any money. So you could have a spouse who doesn't earn anything, and you can pay £2,880 in a tax year, and they can get the additional £720 tax relief, which takes it to that gross amount of £3,600. There are plenty of people who do that because it enables them to build a pension pot, but also because they're getting tax relief effectively. And as a husband and wife, obviously you can pass money between each other without any problem. You can pay into a junior SIP, similar scenario. You can boost your state pension by paying voluntary national insurance contributions. There are rules around this, but it means you can plug gaps that you have in your national insurance contribution record. And you can still do that and go back as far as 2006. And this is due to end in April 2025, meaning you only be able to go back as far as 6 years. So if you want to be able to pay and plug any gaps going back to 2006, you need to hurry up. And I'll then quickly move on to investments. ISA allowance, so you've got your £20,000 ISA allowance in this tax year. It is a use it or lose it allowance. You can't carry forward or anything fancy like that, so you've got to use that. You can obviously hold a cash ISA, stocks and shares ISA, lifetime ISA if you're eligible, that is, and obviously an innovative finance ISA. I always struggle with that one. At the moment, the rules are you can only contribute to one of each type. So you can't pay 10,000 into a cash ISA with one company and 10,000 into a cash ISA with another one. You can pay into a cash ISA and a stocks and shares ISA in the same tax year. The good news, the rules are changing from the 6th of April, where you will be able to pay into multiple ISAs of the same type in the same tax year, as long as you still keep it within that £20,000 overall limit.
And also so long as the provider allows it, because there might be some technicalities moving forward.
Yeah, and I put the link in the notes of the video because I've done a couple of videos on this very topic to explain it in more detail. And as Andy's right, there is something that isn't mandatory in the rules, and it's effectively based on a provider basis. So they can't stop you paying into other ISAs with other people, but they don't have to offer you the ability to pay into, say, 2 cash ISAs with them. So that is something that isn't mandatory and is voluntary. Obviously, paying into junior ISAs, again, is annual allowances with that, £9,000 maximum in each tax year. There is a quirk that's been removed from, or going to be removed from the ISA regime. At the moment, as I make this show, 16 and 17-year-olds can have a junior ISA and an adult cash ISA, and that does mean, therefore, that they can pay a total of 29,000 into ISAs in a tax year, or this tax year. That rule's been removed because it's a bit of a quirk. Not many people knew about it, so that's been removed from the 6th of April, but if you wanted to take advantage of it, then knock yourself out. Obviously, capital gains tax allowances, now this has changed over time, it's becoming less generous. The allowance for the current tax year is £6,000, and that's now being halved to £3,000 in 2024-25. So there'll be people out there that might want to realise gains and use their capital gains tax allowance. Obviously, there are things like bed and breakfast in, or you might have heard bed and ISA in, which is a technique where you can actually crystallise the gain from an investment that's got a gain, use your allowance, and if you put it in an ISA, you can then have it in a tax-free regime. We'll put links in the notes to explain that in more detail. I've not done it justice there. And of course, there are other types of tax incentivised investments like VCTs, for example, that you may want to consider. Moving on to taxation, consider disposing of any capital losses to offset capital gains made elsewhere in the same tax year. That means you'll be able to mitigate the tax you'd have to pay. You can also carry forward excess capital losses, but you must declare them on your tax return within 4 years. There's also the marriage tax allowance, don't forget, so people can use that to try and reduce their taxation as a couple. There are also generous inheritance tax allowances that are tax year sensitive. So each tax year you can give away £3,000. If you don't use it in 1 year, you can carry it forward to the next. So that's if you don't use it in full, but you can only do that for 1 year. You can give away up to £250 per person, but not in conjunction with any other allowances. You can give £5,000 to a child who's getting married, or £2,500 to a grandchild or great-grandchild getting married. And of course, you can always give regular gifts from income, because that is IHT free. So as long as it doesn't impact your standard of living, you can do that. So there are things that people might want to think about around inheritance tax, but if you are in any way interested or not sure, then do seek advice.
Good. Well, that was a whistle-stop tour. As you said, Damien, we will put details and links to that article in the show notes so people can actually go through the details. And you mentioned other things. We provide specific links within that article that go into more detail on each of the subjects. So we cover it in a bullet point form, but if you want to read more, of course, we've got the articles.
And if there's anything else that we think of in the meantime, we'll also add it to the list in the article.
Okay, so we are done for this week's podcast. Please do review the podcast. We asked at the start of the podcast. We're going to ask at the end. Please do rate it 5 stars if you can. And let us know if you review the podcast, because we'll happily... will we happily send them?
We will do, as long as it's 5 stars, Andy. So you could be in line to win a Money to the Masses mug. As ever, do join us on our Facebook group, facebook.com/groups/Money to the Masses. Also follow us on Instagram and all our other social channels. And do subscribe to our YouTube channel, because we're doing a lot on YouTube, as I've mentioned on this podcast. There are a couple of bits and pieces that I've done this week, particularly referencing the ISA changes.
And lots to come up in the weeks ahead, because I've seen the schedule of your filming schedule, and it's looking pretty stacked.
It's pretty stacked. And going in to the next tax year, just to sort of peep under the curtain, I think I'm going to be doing a lot more on video and YouTube and things like that. So that will be quite exciting.
Okay, so that's it. We are done for this week. Until next time.
Until next time.